Hi, good morning. This is Isaac with Cordant Wealth, and this is our market update for Friday, March 27th. Mentioned in the past, when there's a lot going on in the markets, we want to be proactive in our communication, and this is our effort to do that. We're going to try to do these more frequently, so if you have questions or topics you'd like us to address here, please let us know. So let's get into it. So really what I want to hit today is what's going on in the markets, where are we today, what are we watching, what are some of the things that are driving the markets, what are actions we're taking, and then what are some research that we're paying attention to in terms of where the market might go from here and how to participate in a recovery. So where are we now? So year to date, we were at one point from the peak here to the trough here down about 34% in the S&P 500, which are the largest 500 stocks here in the US. Year to date, down about 18% there. Some other international indices right around there, and then small cap stocks down year to date around 30%. Also point out here, these are some bond indices. So we saw them participate in some of the downturn and then bounce back. These are municipal bonds here, and then this is corporate bonds. And I'll touch on that a bit later in terms of some actions that the Federal Reserve took that affected some of these markets. So want to get into that, but that's kind of some perspective on where we are. We had a nice little bounce back in the last 3 days. Obviously, we don't know if we're out of this period. A lot of it depends on how quickly the economy resumes operation, how quickly we can get the health crisis under control. Just in terms of perspective on that peak to trough 34% drop, that's about an average bear market. But Goldman Sachs did some analysis on different types of bear markets. And again, when we're looking at these drops for the markets, this is not your portfolio. All of our clients have a balanced stock and bond portfolio, so they're not going to participate in all of the downturn. But we're just looking at the stock market indices. So 3 different types of bear markets. So there's a structural, think like 2008 style bear market, which is a credit crisis. There's a cyclical, which is more of an average business cycle recession. And then there's an event driven. So these would be things like wars, oil price shocks, or right now, a global pandemic. And what's interesting is on average, these event-driven bear markets tend to be shorter and have quicker time to recover. So time will tell if this is an average event-driven type bear market or not. One of the other factors that we have going on right now is essentially an oil price war between Saudi Arabia and Russia, and that's factored into this global pandemic as well. And so we'll see, but I think a little bit of a silver lining is, if this tends to be more of an event-driven type of bear market, maybe it'll be shorter and maybe the recovery time will be faster. So quickly on those bear markets that they looked at. So we're down 34. We were down in a pure stock index about 34%, which compares the average about 35. Also, what does it look like on the other side? At some point we bounce back and we recover. And 1 year later on average, the US market's up about 47%. Small cap stocks are up about 74%. And then this is 3 years and 5 years. So one thing to note is, if you've participated in the bear market, the drop, you want to be able to participate in the subsequent recovery as well. Other point to note, and we're going to look a bit at this later, is what has performed better. And over time, on average, you can see small cap stocks have tended to outperform on the recovery side. So we'll look at that in a bit. So just some perspective on this notion of, it seems like everybody's selling. I don't like the fact that there's a lot of sellers out there and everybody's doing it. So this is just some data on VTI, which is the Vanguard Total Market Index Fund. And what it's looking at is the flows in or out of that fund over this period from March 16th to March 20th. And what you see over this period is about $1.2 billion came into this fund across all Vanguard equity mutual funds from the 5 days subsequent to this. About $6 billion came into these funds. So I know it feels like everybody's selling in an environment like this, but clearly not everybody is. There's some people that are actually putting money into stock indices during a period like this. So just a point to note, you're not alone in terms of, participating, but also participating in the subsequent recovery as well. Okay, so what are we watching? So one of the things that obviously matters from both a human perspective, but also from an economic perspective is, are we effective in terms of slowing the spread of the virus? So here we're looking at the US, we're looking at South Korea, and we're looking at Italy, and we're looking at new and cumulative cases of COVID-19. So what you see South Korea has done is the cases peaked and then they kind of leveled off and then dropped. what we're watching is, how quickly does the United States and some other countries get to that point? So here we're looking at Italy, which has had obviously some major outbreaks. Maybe peak, maybe drop off. It looks like we're hopefully in this period here. US, we're still kind of ramping up. So one of the things we're paying attention to is how effective are the measures we're taking in terms of dropping the number of new cases and slowing the spread. Interesting to note, kind of on a case-by-case basis, the outbreaks initially started in Washington State and then California. Largest outbreaks now are in New York and New Jersey, which have about half the total cases. So the measures were taken here in terms of social distancing earlier than they were across some of the other areas of the country, and it seems to be effective. The new cases haven't grown as much here as they have in New York and New Jersey. And this is not just a testing issue. Per capita, Washington State has had actually more people tested than New York. And so it seems like the measurements have been effective so far, and we'll see how that plays out, but it's something that we're obviously watching. Additionally, paying attention to any action Congress takes. They've announced a really large stimulus package here yesterday, and $2 trillion. Just to put that into a little bit of perspective, a billion seconds was basically earlier this month. A million seconds was earlier this month. A billion seconds was in 1989, and a trillion seconds was a 10,000 BC. So a trillion's a really big number. But in terms of the highlights, obviously some funding for healthcare, obviously some payments for individuals. That kind of gets the headline. Tax relief in terms of no RMDs for this year are required. Some charitable deductions and filing dates are extended. They are expanding and upping the amount on unemployment insurance, and then rolling out some loans as well. So we're going to dive deeper into this. So expect to hear more from us on this, but just hitting the highlights here. In terms of Federal Reserve actions, so kind of this is a timeline of some of their actions they've taken recently to stabilize some of the lending markets that we saw earlier. And so kind of the big announcement on March 15th was to cut interest rates to zero and announce about $700 billion of quantitative easing. Another big announcement here is here on March 23rd, and that instead of $700 billion, they basically announced unlimited support. And they're going to step into some other markets, the corporate credit market, and then also the what they call term-backed asset securities, which are things like real estate loans, auto loans, some of the individual loan markets, and also TBD, but have announced that they're going to participate in the Main Street business lending program to support Main Street, which is expected to be announced anytime. So one thing, there's a little bit of consternation around some of the actions that the Federal Reserve has taken. One thing to note is back in 2008, they did some of these same things, and they actually made money on a lot of these programs. They're stepping in as a buyer. They're being, essentially, to use the Warren Buffett quote, they're being greedy when others are fearful. They've actually made money for taxpayers through doing some of these things. So just some context there. All right, so in terms of actions that we're taking, we had a blog post that we put up called our Bear Market Playbook, just to outline some of these things. Not every client is going to be able to participate in all these things necessarily, but most of our clients should be able to participate in some of these things. And so what are we doing in a market environment like this? So the first one is kind of obviously just rebalancing to the risk tolerances of the portfolios. If there's losses in the portfolio, we want to harvest those to offset any gains that we've realized previously this year or subsequent gains. We want to invest any excess cash if people have cash outside that's not invested, or if they have the ability to accelerate either 401k or other retirement account contributions. The market's lower now than it was at the beginning of the year, so we might want to accelerate some of those. Same idea is accelerate Roth conversion. So if we're going to do a Roth conversion anyway, now might be a better time to get that account into a Roth, and any growth from here would be tax-free once it gets into the Roth account. Additionally, doing some things like, does it make sense to use Social Security now with the markets being down, with rates being lower, they're bouncing around a lot, but does it make sense to refinance a mortgage? And then any portfolio tweaks that we would want to make. And again, here, the idea, I know you've heard us probably communicate this before, but it's really hard to predict what's going to happen in the market, but we can observe where we are and are there any things that we want to do to take advantage of that. So that's what we're going to look at there. And that's kind of the last section, is this research section here. What are we looking at now in terms of how to position ourselves for a good opportunity to take advantage of where we are? And what we want to touch on here is just a high level overview, and expect us in subsequent updates to dive a little bit deeper into some of this research. But what I wanted to take a look here is just after a bear market, how do some of the factors, the way we're building some portfolios, how do they perform? So we're primarily looking at value stocks versus growth stocks, and then small cap stocks versus large cap stocks. And what you see is kind of across markets and across time, these factors tend to perform pretty well after a bear market. So we're looking at kind of the average performance of these factors in prior bear markets. Important to note here that we're looking at not just total performance, but the difference in performance. So right here, this green bar, 25%, is how much better US value stocks have done versus growth stocks 1 year on average after a bear market. And so you see that same thing with, small stocks have outperformed large stocks by about 26% after a bear market on average. And you see that across markets and across time, and go out to 5 years and you see some pretty big differences. And this is looking at emerging value stocks versus emerging growth stocks. 5 years after a bear market, they tend to outperform pretty strongly their counterparts. So that's one thing we're looking at. I'd expect more from us on this, just in terms of dissecting it a little bit further. We're looking at averages, how frequently do we see these behaviors, and kind of where are the valuations now that should factor into this as well. So that's one of the things we're looking at, and expect, again, to hear more from us on that. So that's it for this week. Thank you. I hope this has been helpful. Hopefully it's provided some good perspective. And again, we're planning on doing these more frequently. So if you have a topic you'd like us to address or questions, please let us know. And as always, reach out. Okay. Thank you. Have a good Friday, and make sure to stay healthy. Bye.